Have you ever wondered whether there are perfectly legal places to keep or grow your retirement money that the IRS simply doesn't count the same way it counts the dollars coming out of a traditional IRA or 401k? Most retirees spend decades believing that taxes are just an unavoidable part of retirement. They assume every withdrawal will eventually be taxed, every investment gain will take another bite out of their savings, and every extra dollar they earn will somehow increase what they owe the government. But here's what surprises many people. The tax code has quietly included several powerful opportunities for years that can dramatically change how much of your retirement income actually ends up in your pocket. The problem isn't that these strategies are secret. The problem is that very few people ever have them explained in plain English before they retire. And by the time many finally hear about them, they've already paid years of unnecessary taxes that could have been legally avoided with better planning. Think about that for a moment. Imagine two retirees who saved almost exactly the same amount during their working years. They earned similar salaries, invested in similar funds, and retired at roughly the same age. Yet one of them spends retirement writing much larger checks to the IRS every year, while the other legally keeps thousands of extra dollars simply because they understood where to place different pieces of their savings. Their investment performance wasn't dramatically different. Their retirement lifestyle wasn't dramatically different. The biggest difference was knowing how the tax rules actually work before they started withdrawing their money. Retirement isn't only about how much you've saved. It's also about how much of those savings you actually get to keep after taxes. That's exactly what we're covering today. We're going to look at 3 of the most valuable retirement accounts and tax strategies that many people overlook until it's far too late. When people say these accounts are invisible to the IRS, that phrase can sound dramatic, so let's clarify exactly what it means. These accounts are not hidden from the government. They are completely legal, fully recognized by the IRS, and must still follow the rules established in the tax code. What makes them so powerful is that under the right circumstances, the money inside them either grows without annual taxation, comes out completely tax-free, or avoids increasing the taxable income calculations that determine how much you owe. In other words, the IRS isn't ignoring these accounts. They're simply treating them far more favorably than the accounts most retirees rely on every day. To understand why this matters so much, picture someone retiring with $500,000 sitting almost entirely inside traditional retirement accounts. Every year, they begin withdrawing enough money to pay their bills, buy groceries, travel occasionally, and enjoy retirement after decades of hard work. The unfortunate reality is that each withdrawal increases their taxable income. Those withdrawals can also influence how much of their Social Security becomes taxable, whether they pay additional Medicare premiums in future years, and even which tax bracket they fall into. Suddenly, retirement planning becomes much more complicated than simply deciding how much money to withdraw. Every decision has a ripple effect, and those ripple effects can quietly cost retirees thousands of dollars over time. Now imagine another retiree who has built multiple sources of retirement income, instead of depending entirely on traditional retirement accounts. When unexpected expenses arise or additional income is needed, they have the flexibility to choose where that money comes from. Some withdrawals increase taxable income, others don't. Some affect Medicare calculations, others leave those calculations untouched. That flexibility gives them something incredibly valuable in retirement: control. Instead of letting taxes dictate every financial decision, they can often decide which pool of money makes the most sense to use in a given year. That level of control can become just as valuable as the investment returns themselves. Today's discussion follows a very specific order, because each strategy builds on the previous one. The first account is one that millions of Americans have heard of, but surprisingly few maximize correctly. The second account may be the most tax-efficient savings vehicle ever created under U.S. law, yet many eligible workers barely scratch the surface of its potential. And the third isn't really an account at all. It's a provision within the tax code that countless retirees overlook, despite the fact that it can legally eliminate federal taxes on certain investment gains under the right circumstances. By the end of this video, you'll understand why financial professionals often spend just as much time discussing where retirement money should come from as they do discussing how to invest it in the first place. Before we begin, remember that every person's financial situation is different. Income, retirement age, investment balances, healthcare costs, state taxes, and estate planning goals all influence which strategy makes the most sense. The goal today isn't to tell everyone to make the exact same decision. The goal is to make sure you know these opportunities exist so you can ask better questions, make more informed decisions, and potentially keep more of the money you've spent a lifetime earning. Let's begin with the first account, because although you've almost certainly heard its name before, there's a very good chance nobody has ever explained why it can become one of the most valuable pieces of a retirement income plan. The first account on our list is one that nearly everyone has heard about, but surprisingly few retirees truly understand. At first glance, a Roth IRA doesn't seem all that exciting. Unlike a traditional IRA, it doesn't give you an immediate tax deduction when you contribute. Many people stop their research right there and assume it's the worst option because they don't receive a tax break today. But that way of thinking focuses on saving a little money during your working years instead of potentially saving a tremendous amount during retirement. The real value of a Roth IRA isn't what happens when you put money into it. The real advantage begins years later, when that money has had time to grow and you finally start using it. Here's why so many financial planners place such a high value on this account. Once you've met the IRS requirements, qualified withdrawals from a Roth IRA generally come out completely free from federal income tax. Think about what that means in practical terms. Suppose your investments doubled or even tripled over the course of 20 or 30 years. In many taxable investment accounts, every gain would eventually become part of the tax conversation. Inside a Roth IRA, however, those qualified withdrawals generally aren't added to your taxable income. That creates flexibility that many retirees don't realize they have until they begin carefully planning where each dollar of retirement income should come from. Imagine you're retired, and your roof suddenly needs replacing. The contractor estimates the repair will cost $15,000. If every dollar you withdraw comes from a traditional retirement account, that withdrawal may increase your taxable income for the year. It could even affect other parts of your financial picture, depending on your circumstances. But if you have sufficient money available inside a qualified Roth IRA, you may be able to cover that unexpected expense without creating additional federal taxable income from the withdrawal itself. That's an enormous difference because retirement rarely follows a perfectly predictable budget. Cars break down, medical expenses appear unexpectedly, family emergencies happen. Having one source of money that doesn't necessarily increase your taxable income gives you far more flexibility than relying on a single type of retirement account. Another reason this account has become increasingly valuable is because retirement today often lasts much longer than people expect. Decades ago, many retirees planned for 10 or 15 years after leaving the workforce. Today, it's not uncommon for retirement to last 25 or even 30 years. During that time, investment growth can be substantial. Every year those investments continue compounding inside a Roth IRA, future qualified withdrawals remain one of the most tax-efficient sources of retirement income available under current federal law. The longer the money stays invested, the greater the potential advantage becomes. Something else that often surprises retirees is that the Roth IRA isn't only about paying less tax today. It's about creating choices later. Financial professionals frequently talk about something called tax diversification. Most people understand investment diversification, meaning they spread money across different investments rather than putting everything into one stock or one mutual fund. Tax diversification works in a similar way. Instead of keeping all your retirement savings in accounts that receive identical tax treatment, you build several different sources of retirement income. Some money may come from taxable accounts, some from traditional retirement accounts, some from Roth accounts. Having multiple options allows you to decide each year which source makes the most sense depending on your overall financial situation. That flexibility becomes especially valuable during years when your income unexpectedly changes. Maybe you decide to sell a rental property. Perhaps you receive an inheritance, cash out a business investment, or simply have unusually high medical expenses. Every one of those situations can affect your taxes differently. If all your retirement savings are concentrated in one type of account, your options become limited. But when you have multiple pools of money that receive different tax treatment, you gain the ability to make much smarter withdrawal decisions from year to year instead of being forced into the same strategy regardless of circumstances. Of course, it's important to understand that the IRS has rules governing Roth IRAs. Contributions are subject to annual limits, eligibility may depend on your income, and qualified tax-free withdrawals generally require meeting both age and holding period requirements established under federal tax law. These aren't hidden loopholes or secret exemptions. They're clearly defined rules that have existed for years. The challenge is that many people don't learn how valuable those rules are until they're already close to retirement, when they have much less time available to take advantage of decades of tax-free growth. For retirees who already have significant balances inside traditional retirement accounts, this doesn't necessarily mean they've missed every opportunity. Some individuals explore Roth conversion strategies over time, carefully moving portions of traditional retirement savings into Roth accounts while considering the tax consequences of each conversion. Those decisions require careful planning because converting money generally creates taxable income during the year of the conversion. But under the right circumstances, some retirees decide paying taxes today may reduce taxes over many future years. It's not the right choice for everyone, but it's one example of how understanding the rules can create planning opportunities that many people never realize exist. Perhaps the biggest lesson from the Roth IRA isn't simply that withdrawals can be tax-free. The bigger lesson is that retirement planning isn't just about building wealth, it's about building flexibility. Every additional option you create gives you greater control over your finances later in life. And as you'll see with the next account on our list, flexibility may be even more valuable than most retirees realize. Because the second account isn't just designed to save taxes. Many experts consider it one of the most powerful tax-advantage savings tools ever created. Yet millions of eligible Americans either ignore it completely or use only a fraction of its full potential. The second account is one that many retirement experts describe as one of the most tax-efficient financial tools available under current law. Yet it's still one of the least understood. That's the health savings account, commonly known as an HSA. Many people think of it as nothing more than a place to set aside money for doctor visits or prescriptions while they're still working. In reality, for those who are eligible to contribute, an HSA can become much more than a medical spending account. It can become a long-term retirement asset with tax advantages that are difficult to match elsewhere. Money generally goes into the account with favorable tax treatment. It can grow over time through investments if the account provider offers that option, and qualified withdrawals for eligible medical expenses are generally tax-free under federal law. That's why many financial professionals refer to it as offering a unique combination of tax benefits. What makes this account especially valuable is that healthcare often becomes one of the largest expenses retirees face. Even individuals who have planned carefully for retirement are frequently surprised by how much they eventually spend on premiums, deductibles, dental care, vision services, hearing aids, prescriptions, and other medical costs that arise over time. Having a dedicated source of funds specifically intended for qualified healthcare expenses can reduce the need to withdraw additional money from taxable retirement accounts just to pay those bills. Instead of increasing taxable income to cover every unexpected medical expense, eligible retirees who have accumulated HSA savings may already have a pool of money available for many of those costs. Perhaps the biggest mistake people make is treating the HSA like a checking account instead of a long-term investment opportunity. Many account holders deposit money throughout the year and spend it almost immediately on routine healthcare expenses. While that certainly isn't wrong, some financial planners take a different approach when clients can comfortably afford it. They pay current medical expenses from other funds, allow the HSA balance to remain invested, and preserve those tax advantages for years or even decades. By allowing the investments inside the account to continue growing, they create a larger reserve that may become extremely valuable later in retirement when healthcare costs often increase. Of course, not everyone can open or contribute to an HSA. Eligibility depends on being covered by a qualified high-deductible health plan and meeting other IRS requirements. Once someone enrolls in Medicare, the rules surrounding new HSA contributions generally change, although previously accumulated funds typically remain available for qualified purposes. Understanding those timing rules is important because many people unintentionally miss years of potential contributions simply because nobody explained how valuable the account could become before retirement. Account number 3. Long-term capital gains, a tax rule that many retirees never fully use. Now let's move to the third strategy. And this one surprises almost everyone because technically it isn't a retirement account at all. Instead, it's one of the most overlooked tax opportunities available to retirees who own investments in taxable brokerage accounts. Under current federal tax rules, certain long-term capital gains may qualify for very favorable tax treatment depending on your taxable income. That means some retirees can legally sell appreciated investments while paying little, or in some situations, no federal tax on those qualifying gains. The reason this catches so many people off guard is because many retirees spend years avoiding taxable investment accounts altogether. They hear phrases like taxable account and automatically assume those accounts should always be used last. But retirement planning isn't that simple. Depending on your income, your filing status, and the nature of your investments, a taxable brokerage account can sometimes provide opportunities that traditional retirement accounts simply cannot. Rather than automatically assuming every investment sale creates a large tax bill, retirees should understand how long-term capital gain rules actually apply to their specific situation. Imagine a retiree whose annual taxable income remains relatively modest because they carefully manage where their retirement income comes from each year. If they also own investments that have appreciated significantly over many years, selling a portion of those investments may produce a much smaller federal tax obligation than they expected. Instead of withdrawing additional taxable money from a traditional IRA, they may be able to strategically realize long-term capital gains while remaining within favorable tax thresholds. This doesn't eliminate taxes for everyone, nor does it apply to every investment, but it demonstrates why retirement income planning is about much more than simply withdrawing money from whichever account has the largest balance. The broader lesson here is that every retirement account and investment vehicle serves a different purpose. Traditional IRAs provide one set of advantages. Roth accounts provide another. HSAs create opportunities specifically related to healthcare expenses. Taxable brokerage accounts may offer flexibility through long-term capital gain treatment. None of these strategies work exactly the same way, and none should be viewed in isolation. The most effective retirement plans are often built by combining several different types of accounts rather than depending entirely on one. Final thoughts. When you step back and look at the bigger picture, one theme becomes impossible to ignore. Successful retirement isn't determined solely by how much money you've managed to save over your working life. It's also shaped by how efficiently you use those savings once retirement begins. Two people with identical retirement balances can experience dramatically different outcomes simply because one understands the tax rules while the other withdraws money without a long-term strategy. That's why learning about these accounts isn't just an academic exercise. It can have a meaningful impact on how long your savings last and how much financial flexibility you enjoy throughout retirement. It's also important to remember that the phrase, invisible to the IRS, can be misleading if taken literally. These accounts and tax rules are not hidden, secret, or outside the law. They are specifically authorized under federal tax law and come with their own eligibility requirements, contribution limits, withdrawal rules, and reporting obligations. The real advantage isn't hiding money from the government. It's understanding the rules well enough to legally take advantage of the benefits Congress has already written into the tax code. That's a very different concept, and it's one every retiree should understand. If there's one takeaway from today's discussion, it's this. Don't wait until you're already withdrawing retirement income to start thinking about taxes. The decisions you make years before retirement often determine how much flexibility you'll have later. Reviewing your retirement accounts, understanding how each one is taxed, and speaking with a qualified tax professional or financial advisor before making major decisions can help you avoid costly mistakes and potentially keep more of the money you've worked so hard to earn. If you found today's video helpful, don't forget to subscribe and turn on notifications, because we regularly cover important retirement updates, Social Security news, Medicare changes, tax planning strategies, and financial tips designed to help retirees make informed decisions. And if you know someone who is approaching retirement or is already retired, share this video with them. Understanding these strategies today could make a meaningful difference in their financial future. Thanks for watching, stay informed, and I'll see you in the next video.